Hello there, I'm Erin Real coming to you from the floor of the New York Stock Exchange with Cameron Dawson from NewEdge. You're the CIO. Welcome. Thank you for being here today.
Thank you so much for having me.
We're going to dive right in. So let's talk about the current state of the economy and optimism, a lot of it, abundant at the moment. So do you see this accelerating in 2026?
Well, I think it's really important to start with where estimates have come from. If we go back to about 6 months ago, people were expecting growth to be just about average for the U.S. economy, about 2%. And now those have been revised higher to 2.4%. And a lot of that has been because the consumer has been more resilient than people were expecting. And so estimates still look fairly healthy for U.S. economic growth. We think that we can certainly achieve that. But whether or not that translates into better returns for U.S. assets remains to be a question which I'm sure we'll get into.
And I'm glad you bring up the consumer because the U.S. consumer is vital to the economy, obviously. So what are the headwinds and the tailwinds that you see there?
Yeah, it's good to remember that the U.S. consumer is 70% of the economy. So goes the consumer, so goes the U.S. economy. And one of the things that we're seeing is, of course, we know that there's some pressure on consumers when it comes to wage growth. Real wage growth, which is effectively how much they're making minus inflation, has been negative really since April of last year. So consumers are starting to feel the pinch, not just from the softening labor market, but from this continued rise in prices and inflation. So that's one aspect. But what has been helping the consumer a lot is strong equity prices and strong home prices. Remember that top end of the K-shaped economy really benefits from the wealth effect. So the equity market continuing to go up is actually very vital for consumer spending. There's one thing we're watching really closely. Equal weight consumer discretionary versus staples. This is the ratio that effectively says the equity market thinks you should be optimistic about the consumer. It's been underperforming to start the year in 2026, so if there's one watch item, keep that ratio in mind.
Let's move on to the Fed. How do you think things might look different under Kevin Warsh?
Yeah, well, good to remember. The Fed's mandate is not about growth. It's about full employment and stable prices. So we could be in an environment where U.S. economic growth, as we just spoke about, could be above trend and in that mid to high twos. But if the U.S. labor market continues to slow down, in theory, it would allow the Fed to be able to potentially deliver more rate cuts. The question is, and really important to note, is that Warsh is just one voting member, and he is chair, and usually we do see that the Fed votes alongside of the chair. But let's say, in the hypothetical, we find ourselves in June, the labor market is holding up, and we still have this inflation around where we are. Do we really think that the committee would vote for rate cuts, even though we know Warsh is effectively been hired to deliver those rate cuts? So we could be in a very rare situation where the chair is voting for one thing as a dissenter versus the rest of the board. Very rare that happens.
Yes, it will be interesting to watch. And what do you think right now on current valuations and concentration of risk? Where is that?
Yeah, we have spent so much time over the last couple of years talking about how the U.S. equity market was not only highly concentrated, but as well as extremely expensive, mostly versus the rest of the world, meaning that U.S. equities traded at a huge premium to everywhere else in the world equity markets. And some of that is now coming under pressure to start this year. If you look at the source of some of the weakness within the market, whether we're looking at it from a broad perspective or looking at it from the underlying components for software, for example, which has been one of the weakest areas, all of the weakness has been driven by valuation, not actually by earnings estimates getting cut. So maybe we're now at the point where investors are looking around saying maybe the U.S. equity market shouldn't trade at a 50% premium to the rest of the world. And that's usually how valuations work. They're not a great timing tool, but we see them as an amplifier. Once you get a catalyst, if you're starting from a high valuation, that's where you can see a lot more downside moves. So it remains an important driver of returns, not necessarily the thing that is the catalyst for those returns to happen.
And Cameron, how do you feel about the recent leadership rotations? Is this going to last?
Yeah, it's so important because we've been calling this the duck market, and we've had different duck markets at times where it's calm on the surface, but then the little legs underneath are paddling like crazy. And that's been the nature of this leadership rotation. The equity market has been effectively flat for the last 4 months, but under the surface, you've gone from having tech be the main leader and everything else losing to now cyclicals and defenses are doing better and tech is lagging. So it's a classic last shall be first market where the worst performers are doing the best. Look at the fact that energy and staples are some of the best performing sectors, and those were the worst performing sectors over the prior 10 years. So some of these rotations can continue, but for them to be more than just a flash in the pan, we think they have to be supported by real earnings dynamics, meaning earnings in those laggard areas have to start to catch up to some of the prior leadership.
And we can't have an interview with anyone without discussing AI, so I'm going to bring it up. Where do you think the investment opportunities there are, and what is, on a broader scale, the macroeconomic impact?
I think that the AI digestion right now and some of the, even you might be able to call it hysteria, has caused a lot of price action to be what we would say is a monolith on the way down, meaning everything gets sold very quickly. AI is a threat, just sell it immediately. What we think will happen is that it won't be a monolith on the way back up. There are certainly going to be businesses that are going to be structurally impaired by AI. However, there are some businesses that will be made far better because of AI. And so it all depends, and this is where active management I think will be really important, is saying what are those business models that benefit from AI and actually see their cost bases come down and makes them more efficient, can grow better. And then what are those businesses that probably see their business models get pretty impaired for the long run? So that's where we're starting to sharpen our pencils now that we've seen a reset in prices.
Cameron, thank you so much for your time and your insight. We appreciate having you here today. And thank you for watching Asset TV. I'm Erin Real, and this is Cameron Dawson, CIO at NewEdge.